So today we're going to talk about Paul Krugman's opinion piece in the New York Times titled, "Is the Era of Cheap Money Over?" So let's switch to the story and I'll highlight it. What I'm thinking as I go through it. Okay, interest rates are up, stocks, especially glamour stocks like Tesla, are down, and the crypto crash. What's going on? Well, many people have been offering an overarching narrative that runs something like this. For the past 10 years, maybe even 20, the Fed has kept interest rates artificially low. Now, it's a key question about artificially low. Like right there, my brain just says, well, wait a minute. You know, if I taste some vanilla bean in my ice cream, right, it's legitimate vanilla bean taste. If it's a artificial vanilla bean, it's not coming from the right source. It's not real. So when you say interest rates are artificially low, what are you really saying? You're really saying that somebody is using something that's not really the same thing and putting it in its place. And I actually don't believe you can do this. But anyway, he's artificially low is sort of one of those words like you need to spend, I think, a full article explaining that. Anyway, let's move on. These low rates, inflated bubbles everywhere. So, you know, once again, inflated bubbles everywhere. What bubbles are you talking about? He'll go into one. As investors desperately looked for something that would yield a decent rate of return. And now the cheap money is over, nothing will be the same. Okay, let's move down. You can see this narrative's appeal. It ties everything up into a single story. Yet to paraphrase Mencken, there's always a well-known explanation for every economic problem, neat, plausible, and wrong. No, interest rates aren't artificially low. And no, they don't cause the bubbles. No, the era of cheap money probably isn't over. Well, like I said, what do you mean by artificially low? I mean, are you saying that the Fed has two types of bonds, the bonds with an artificially low interest rates and bonds with a non-artificially low interest rates? Are you saying that that's all the Fed creates are artificially low interest rates? You know, what do you really mean by that? And the other thing that really gets me is cause the bubbles. Like what bubbles? All bubbles? Some bubbles? What bubbles are you talking about? And, you know, he's going to pick and choose. So I just feel it's a dishonest story right away. It's a dishonest opinion piece because he's basically saying, you know, people who say that, you know, that low interest rates are over, you know, they don't know what they're talking about. Their answers are too simple. My answers are better, even though they're just as simple, if not more simple, and I feel in a way misleading. So let's just keep going forward. So let's start with those interest rates. So he wants to show interest rates over time. Now he says artificially low, and you know what cracks me up is this is basically, you know, the period, let's say before the 60s, right? And this is pretty much, you know, this is just an oil shock here. So ignore this. So basically I would say this is the period until 2000. So you had 3%, 4%, and then since 2010, this is the interest rate, 1%, right? So you had 3%, then it went to 4%, then it went to 1%. Okay, so wouldn't you say that compared to this, let's say the average of this, so the average for the past 50 years has 3.5 has been the average for the past 50 years, right? Wouldn't you say 1% is artificially low? Or maybe, again, artificial, not artificial. Let's just say it's very low. Let's go back up to his what he says. There's indeed a huge decline in real rates after 2000. So he's admitting that. But was this decline artificial? There we go again. It's that artificial word he keeps going on to. What would that even mean? Well, hey, he's asking the question I'm asking. Short-term interest rates are set by the Federal Reserve. Okay. Short-term interest are set. Oops, sorry. Short-term are set by the Federal Reserve. Are they? See, I don't agree with this because no, short-term, no-risk rates are set by the Federal Reserve. Corporations, yes, in the money markets, commercial paper, they have short-term interest rates for their bonds. I mean, tons of entities, corporations, people, they put out bonds, short-term bonds, right? And they put out the interest rate that the market would need to get for them to buy these bonds. And so, and he says long-term rates reflect expected okay, that's fine. There's no such thing as interest rate unaffected by policy. Let me clear this here. Actually, there's no such thing as interest rate unaffected by everything. Everything goes into interest rates. If you're going to lend money out, are you in a war? Does the economy look like it's going up? Do you have a daughter's wedding to pay for, right? I mean, there's everything in the kitchen sink goes into interest rates. That's why it's very hard to know what's going to happen because we don't know what people are really feeling. Do they want to take risks with their money? Do they have too much money, too little money, whatever? It's more than just policy. Anyway, there's something, getting back to our story, there's something, however, the economists have called the natural rate of interest. The interest rate consistent with price stability, neither high enough to cause the depression or low enough to cause excess inflation. Now, this is a different. Now, what he's basically saying is why the effects that interest rates have on something is why they're set. That makes no sense to me whatsoever. The interest rate is consistent with price stability. Nobody sells a bond to get price stability, right? Nobody. I don't think. I mean, nobody says, oh, you know what? I want 3%, but for the sake of price stability, I'm going to go for 2%, right? And it says neither high enough to cause depression or low enough to cause excess inflation. Again, nobody is like lending money saying, this might cause excess inflation. I'm not going to lend at this. So the interest rate, what they're saying, what economists are saying is that interest rates generally, if you have excess inflation, right, they're going to go up. If there's price stability, they might go down. These are reasons why ultimately interest rates would go up or down. It sort of explains what we would see that would mean that they would go down, but they aren't actually the things that move interest rates. Interest rates, yes, they're affected by policy, but again, they're affected by anybody. And just by saying that, oh, well, if interest rates are too high, they come down. If they're too low, they go up. What is that saying? That's not saying anything. That's like saying, oh, when the tide goes out, it'll come in. When it comes in, it'll go out. I mean, we all know it goes in these patterns. Okay. So is the claim that the Fed was consistently setting interest below this natural rate? Again, he's asking a question, well, are we setting interest rates below the natural rate that would sit between depression and inflation? As if depression and inflation are actually moving interest rates. They are not. They're secondary effects. So anyway, it says, in fact, until inflation consistently came in more or less the Fed's target of 2% per year. So basically saying, well, okay, interest rates were basically where everybody wanted them to go, but then why are they so low? Okay, so, but why was the natural rate so low? The immediate answer is the Fed learned from experience that had to keep rates low to keep the economy from slipping into a recession. Okay, so if the economy is going to slip into recession because interest rates are high, who's making interest rates low, right? I mean, if you're about to go in recession, in inflation, right? If prices are too high, right, then people are going to lower rates anyway to get that capital, to get that money going in. It has nothing to do with the Fed. The Fed is just another, and that's the thing that also irritates me. Again, tons of entities, thousands, maybe millions the world over sell bonds. The Fed is just one seller. It's a seller that's a special seller because it's backed by the U.S. Treasury. So yeah, it's considered risk-free, but it's still just a seller. At the end of the day, you can't tell what bond you have. All you know is you get, money every month, or you get the money after 1 year, 3 year, whenever the bond matures. That's all you know. You can't tell a Fed bond from any other bond. That's just something you see. So, okay, I'm already at 10 minutes. I think I'm going to stop for now. Or no, I'll just keep going. Okay. Maybe prices didn't shoot, but look at the asset bubbles. Okay. So he says, then he goes into the asset bubbles. But look at all these asset bubbles. What asset bubbles? He's really probably just talking about real estate, right? Your homes. That's what people really see. They don't see asset bubbles maybe they see them in stocks and houses. That's it. And there have indeed been some big bubbles in the era of low interest rates. And then what he does, I'm just going to fast forward now here through this a little bit. He talks about the 1990s, and basically in the technology stocks, he's basically saying that, okay, there's a bubble in technology stocks, and he doesn't really have a good chart for this, but anyway, there's a bubble in technology stocks. Well, I guess we can see it right here. And what he's saying is that the bubble of technology stocks that went from here to here, oops, how did that happen? Go back. He's saying that in the bubble of technology stocks that went up here, there's also high interest rates. You should show the interest rates along here, but take my word for it. But you're talking about one of the biggest inventions of mankind, the computer chip, which increased productivity like 10, 20-fold. So of course, so much productivity was being increased that they couldn't put money into the tech industry fast enough. So of course, tons of profits are coming out. And that's what people are getting. You get really high profits, interest rates are going to go up, right? Because when you lend money into an industry that you know is growing a lot, you want a lot of money back. In fact, that's really why we have low interest rates now, in my opinion. There's just no profits anywhere to really get interest rates. Anyway, so this is a false analogy. You can't compare the invention of the computer chip, that period in interest rates, and now when nothing new has been invented in the past 10, 20 years, right? Name me one thing in the past 10 years that even comes remotely close to the productivity increasing thing of the computer chip. Nothing. So to say that, the interest rates that have nothing to do with bubbles, that you're talking about one bubble that was in tech, another bubble that is just in basically a pieces of steel and plywood and concrete. I mean, no, apples and oranges. All right, I think that's enough. I'm at 13 minutes. That should be safe. Oh, no, let me just see if I go to the bottom. Anything else? Let's just go to where he ends. In that case, have rates shot up? Well, the Fed is raising rates right now to fight inflation. Oh yeah, this is another one of my big bugbears. Okay, so where am I? Did I just lose my pointer? Where is it? Oh, look at this. I'm using a pen. I picked up a pen. Okay, so he's saying that he's raising rates to fight inflation. Now, when you get inflation, you have to raise rates. You can't possibly not raise rates. And this just annoys me because this is so fundamental, and economists like to pretend, because they're friends with the Fed, that they control interest rates based on inflation. Let's just say we have interest rates at 0, right? And we know inflation is going up, right? And you have a friend that has a truckload of soybeans or whatever, right? Or just like cereal, a truckload of cereal boxes, and they're a distributor. Well, what would you do? Borrow the money, go to your friend, say, hey, listen, I want to buy that truck. You keep it here, and then you bring it to Market Basket in a year, right? You know there's 30% inflation. You borrowed at 0, you buy the truck, a year the truck goes, it goes up 30%, you take a 30%. So in a sense, your self-bond made you 30%, right? Well, that's what everybody would do. When inflation is going up, everybody wants to borrow at low rates to buy things that they know are increasing in price. So as a bond seller, you have to raise prices. You have to. Otherwise, you'll be taken to the cleaners. Right? So it's not, the Fed isn't raising rates because like, well, maybe I'll fight inflation, maybe I won't. They have to, or the Treasury will get its clock cleaned. Ugh. Anyway, then he goes down to does this mean there will be more bubbles in the future? Well, yeah, there are always bubbles in the future. There have been bubbles since mankind. But then he says, yes, but there would be more bubbles even if interest rates stayed high. Well, of course. I just said bubbles have nothing to do with the interest rate. Though he just made the argument that interest rates have nothing to do with bubbles. But anyway, it has nothing to do with they're high or they're low. They're not related. So what? Who cares? It doesn't mean people that are making the point that we have bubbles now because of low interest rates. That's still true, but it's a specific situation when there's no growth and you have low interest rates. You get bubbles in assets. What people are saying is it's nothing like crazy. If you have high growth economy, like productivity with microchips, then interest rates will go high because everybody wants in a piece of an action. But they're two totally separate things, apples and oranges. So, I don't get why, because interest rates went higher during the technology boom, what that has to do with today's low rates fueling asset bubbles that are creating a lot of wealth inequality. All right. Okay. Well, I don't know. I'm just starting these videos again. I don't know whether any of that was interesting, me blathering on and on about this stuff. But anyway, got to start somewhere. And here it is. Thanks for watching.